The FOMC raised its policy interest rate by 0.75 of a percentage point, and we anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. Restoring price stability will likely require maintaining a restrictive policy stance for some time. The historical record cautions strongly against prematurely loosening policy.
And on this same subject, he says, what are your current thoughts on the inflationary environment? And please compare and contrast it to the 1970s.
When Volcker, after the 70s, took the prime rate to 20% and the government was paying 15% on its government bonds, that was a horrible recession. Lasted a long time, caused a lot of agony. And I certainly hope we're not going there again. Conditions that allowed Volcker to do that without an interference from the politicians were very unusual. 2020 hindsight, it was a good thing that he did it. I would not predict that our modern politicians will be as willing to permit a new Volcker to get that tough with the economy and bring on that kind of a recession. So I think the new troubles are likely to be different from the old troubles. You may wish you had a Volcker-style recession instead of what you're going to get. The troubles that come to us could be worse than what Volcker was dealing with.
Charlie Munger, a billionaire investor and Warren Buffett's partner at Berkshire Hathaway, warned of serious difficulty for the markets at the Daily Journal's annual meeting earlier this year. With the possibility of another recession looming over us, the prediction is perhaps more timely now. So let's take a look at how to make money during this difficult period. Charlie Munger predicts trouble in the stock market. The conclusion from Charlie Munger's remarks in light of current macroeconomic and market conditions is that future SPY returns are likely to be below average over the next few years. The reasons are fairly simple. The outlook for economic growth is weak, if not negative, for the foreseeable future. Without strong economic growth, earnings growth will also be weak. Interest rates are likely to rise further based on persistently high inflation and recent comments from the Federal Reserve. Higher interest rates in the near term will make the market appear overvalued under the current interest rate model. Higher interest rates will also impact asset valuations and drive them lower. Valuation multiples are still elevated compared to historical averages. Warren Buffett's favorite market indicator is almost 150%, signaling that weakened U.S. equities are still overvalued and at risk of further declines. Buffett's indicator is based on the total market capitalization of all actively traded U.S. stocks and divides it by the most recent quarterly estimate of gross domestic product, GDP. Buffett suggested in a 2001 article for Fortune magazine that stocks would be fairly valued if the indicator were at 100%, suggesting that they are still significantly overvalued today. Buying stocks would probably work very well at 70% or 80%, but around the 200% mark it would be playing with fire, he wrote at the time. As a result, when you combine weak growth with a lack of multiple expansion, and in fact a likely reduction in multiples, low dividend yields, and a likely rise in interest rates, there are no real catalysts to drive stock market returns.
Traditional economic theory argues that excessive monetary and fiscal stimulus over the last 2 years has triggered the highest inflation in 40 years. Do you broadly agree with this thesis? And more importantly, do you think there will be a high economic price to pay as the Fed attempts to bring inflation back under control?
We've done something pretty extreme, and we don't know how bad the troubles will be, whether we're going to be like Japan or something a lot worse. What makes life interesting is we don't know how it's going to work out. I think we do know we're flirting with serious trouble. Think of how seductive it is. You have a bunch of interest-bearing debts, and you pay them off with checking accounts, which you're no longer paying interest. Think of how seductive that is for a bunch of legislators. You get rid of the interest payments and the money supply goes up. It seems like heaven. When things get that seductive, they're likely to be overused.
Charlie Munger's thoughts on inflation. Inflation plays essentially no role in Munger's investment strategy. The billionaire investor largely ignores current macroeconomic trends when making investment decisions. How to invest during a recession. While these are certainly difficult, if not extremely challenging, times for investors trying to navigate the markets, it still makes sense to be invested. However, we should keep in mind the following principles to guide us to be more cautious during this period.
by the declines in the share price of Berkshire Hathaway, the difficulties the
Zero.
company's in?
This
No?
is the third time that Warren and I have seen our holdings in Berkshire go down top tick to bottom tick by 50%. I think it's in the nature of long-term shareholding with the normal vicissitudes in worldly outcomes and in markets that the long-term holder has his quoted value of his stock go down by, say, 50%. In fact, you can argue that if you're not willing to react with equanimity to a market price decline of 50% 2 or 3 times a century, you're not fit to be a common shareholder and you deserve the mediocre result you're going to get.
Think rationally. When investing, you will sometimes experience setbacks, confusion, frustration, uncertainty, anxiety, and disappointment. It's inevitable. How you react to events and to your emotions will be a key factor in your success or lack thereof. At the heart of a rational approach to investing is a framework built on 3 factors: balancing exposure to risk factors, effective diversification, and taking advantage of relative mispricing in financial markets.
A stock market, which some people use like a gambling parlor, and the transactions of the people who love the gambling parlor aspect of the business and those who want to make long-term investments to take care of their old age and so forth. I mean, you muddle it in one market and it goes out of control because the stock market becomes an ideal gambling parlor activity. If I were the dictator of the world, I would have some kind of a tax on short-term gains that made the stock market very much less liquid and drove out this marriage of gambling parlor and legitimate capital development of the country. It's not a good marriage, and I think we need a divorce. What we're getting is wretched excess and danger for the country. And everybody loves it because it's like a bunch of people get drunk at a party. They're having so much fun getting drunk that they don't think about the consequences. This is serious stuff, but a lot of people like a drunken brawl. So far, those are the people that are winning. And a lot of people are making money out of our brawl.
Invest with a long-term time horizon, because long-term investing gives your money the best chance of increasing in value. But this means keeping calm during periods of significant stock market volatility, and remembering that, as history shows, markets usually recover.
Play out, and what's the best advice you have for individual investors to optimally deal with the negative impact of inflation other than owning quality equities?
It may be that you have to choose the least bad of a bunch of options. That frequently happens in human decision making. The Mungers have Berkshire stock, Costco stock, Chinese stock, Sululu, a little bit of Daily Journal stock, and a bunch of apartment houses. Do I think that's perfect? No. Do I think it's okay? Yes. The great lesson from the Mungers is you don't need all this damn diversification. You're lucky if you've got 4 good assets. If you're trying to do better than average, you're lucky if you have 4 things to buy. To ask for 20 is really asking for egg in your beer. It's very few people can have enough brains to get 20 good investments.
Invest in quality companies. Quality companies are those that deliver high profitability over the long term, and whether that profitability is measured as return on equity, return on assets, return on invested capital, or whatever profitability you want to use. Other definitions of quality that we can intersect with are quality in the sense of low leverage or safety, and quality in the sense of high management investment relative to earnings, indicating that management is investing in future growth.
Cool. Ben Graham valuation methods dead.
They'll never die. You can't. The idea of getting more value than you pay for, that's what investment is. If you want to be successful, you have to get more value than you pay for. And so it's never going to be obsolete. Think of the past crazy booms and how they worked out. The bubble in the late 20s, so on and so on. We've had this since the dawn of capitalism. We've had crazy bubbles.
Value investing will always be relevant. According to Munger, value investing will never die. This investment strategy is based on selecting stocks that appear to be trading at a lower price than their intrinsic or book value. Value investors actively seek out stocks that they believe are undervalued by the stock market. They believe that the market overreacts to good and bad news, resulting in stock price movements that do not match the company's long-term fundamentals. overreaction offers an opportunity to profit by buying shares at discounted prices.